Hello and welcome back to Boni's Life, your home for navigating the exciting and sometimes a little crazy world of cryptocurrency. I'm Boni, and it's great to have you with us today. Whether you're a seasoned trader who dreams in candlesticks or you're just starting to dip your toes into the crypto waters, you've come to the right place. We're going to break down what's happening in the market, why it's happening, and most importantly, what you can do about it. The past few weeks have been a roller coaster, to say the least. We've seen a dramatic sell-off that wiped out nearly $2 trillion from the crypto market since its peak. Bitcoin, the king of crypto, tumbled from its all-time high of over $126,000 in October 2025 to as low as $60,000 just a few days ago. That's a nearly 50% drop. So, the big question on everyone's mind is this the beginning of a new crypto winter, or is it a massive buying opportunity? Today, we're going to dissect the market from every angle to find some answers. Let's start with the big picture. As of February 9th, 2026, the total cryptocurrency market capitalization stands at around $2.43 trillion. Now, while that's still a massive number, it represents a significant contraction from the peak of $4.379 trillion. The 24-hour trading volume is hovering around $107 billion, which tells us there's still a lot of activity, a lot of buying and selling happening. Bitcoin's dominance, which is its share of the total crypto market, is at 56.9%. This is a crucial number because it often indicates where the market's confidence lies. When Bitcoin dominance is high, it usually means investors are seeking relative safety in the most established cryptocurrency. Ethereum's dominance, by contrast, has slipped to just 10.1%, reflecting the heavier losses in the altcoin space. Now let's talk about feelings. No, not my feelings, but the market's feelings. We measure this with the Crypto Fear and Greed Index, and right now it is sitting at 14, which places us firmly in the extreme fear zone. Just a few days ago, on February 5th, it plunged as low as 7. That is a level of fear we haven't seen since the FTX collapse back in 2022. Now, here's the thing about extreme fear. Historically, it can be a contrarian signal. When the market is this fearful, it often means that the weak hands have already sold, and we could be approaching a bottom. But, and this is a big but, it's also a sign of extreme uncertainty. So we need to be cautious and not just blindly buy the dip. To get a deeper understanding of the market's mechanics, we need to look at open interest and liquidations. Open interest represents the total number of outstanding derivative contracts, like futures and options, that have not been settled. Think of it as a measure of how much money is actively betting on the market. According to CoinGlass data, Bitcoin's open interest currently stands at approximately $45.82 billion, or about 663,420 Bitcoin. In early February, we saw a massive collapse in open interest from its peak, which coincided with the price crash. This tells us that a lot of leverage positions were wiped out in a very short time. And that brings us to liquidations, which is where the real pain happened. A liquidation is when a trader's leverage position is automatically closed by the exchange because they no longer have enough funds to cover their losses. In the first week of February, we saw over $16 billion in liquidations, with a staggering $2.58 billion on a single day. The vast majority of these, over 93%, were long positions, meaning traders who were betting on the price going up got absolutely crushed. This cascade of liquidations is what fueled the dramatic price drop. It's a brutal reminder of the dangers of high leverage. As the legendary trader Jesse Livermore once said, the market is designed to fool most of the people most of the time. So, what's causing all this fear and selling? It's not just one thing, but a perfect storm of global events and economic factors. A major driver has been the nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is known for his hawkish stance on monetary policy, meaning he's more likely to favor higher interest rates and a smaller Fed balance sheet. Barry Eichengreen of Project Syndicate noted that Warsh's preoccupation with moral hazard suggests he wants to discourage risky behavior by banks and reduce asset price inflation. For crypto, which has thrived in an era of easy money and quantitative easing, this is a significant headwind. The FOMC held rates steady at 3.5 to 3.75% in January after cutting 3 times late last year, and the market is now pricing in fewer cuts going forward. Adding to the uncertainty are the ongoing tensions between the US and Iran. Nuclear talks began in Oman this past week, and while both sides described them as a good start, the situation remains fragile. Iran has not changed its core negotiating position, and any escalation could lead to a risk-off sentiment in the markets, where investors flee to traditional safe havens like gold and US dollars and away from speculative assets like crypto. In fact, we've already seen a remarkable divergence between gold, which has been rallying to near $5,000 an ounce, and Bitcoin, which has been falling. This challenges the digital gold narrative that many Bitcoin proponents have been pushing. Brent crude oil is up more than 10% since the start of the year, partly due to the Iranian geopolitical risk premium. And if that wasn't enough, we had some very direct comments from Treasury Secretary Scott Bessent, who on February 4th, during his congressional testimony, explicitly rejected the idea of government bailouts for crypto companies or strategic Bitcoin purchases by the US government. This sent a clear signal that the crypto market is on its own, and it triggered an acceleration of the sell-off from around $80,000 down into the 60s. On top of all this, the US federal government shutdown has delayed the release of key economic data. The employment report was pushed from February 6th to the 11th, and the CPI inflation data was pushed to the 13th. Markets hate uncertainty, and this delay is adding to the anxiety. Payroll growth is expected to have risen from 50,000 to 70,000 in January, with the unemployment rate holding at 4.4%. Now, let's get to the charts. This is where we look for clues about where the price might go next, and we'll look at different time frames for different types of traders. For the short-term trader, the day trader, we're looking at the 1-hour and 4-hour charts. The key level to watch right now is the $68,000 to $70,000 range. This is where the price has been consolidating after the recent bounce from the lows. The RSI on the 4-hour chart is showing a positive divergence, which is a bullish sign. This means that while the price made new lows, the RSI didn't, suggesting that the selling momentum is weakening. A trigger for a long trade would be a confirmed break and hold above 70,000, with a target of 72,000 and a stop loss below 68,000. Keep your position sizes small and your stop losses tight in this volatile environment. For the mid-term trader, the swing trader, we're looking at the daily chart. The picture here is more bearish. The price is trading below all the key moving averages, the 20, 50, and 100-day exponential moving averages. The MACD is also in a bearish crossover. The key support level to watch is the $60,000 to $61,000 zone. This is a major support area, as it's where we saw the low on February 6th. And it also aligns with the 200-week moving average, which has historically been a bottom indicator for Bitcoin. A break below this level could open the door to a much deeper correction, with the next major support around 50,000. A trigger for a short trade would be a rejection from the $72,000 resistance, with a target of 65,000 and then 61,000. Consider using option strategies to define your risk in this uncertain market. For the long-term trader, the investor, we're looking at the weekly chart. The long-term trend is a concern. The price has broken below the 365-day moving average for the first time since March 2022. This is a significant bearish signal that shouldn't be ignored. However, the 200-week moving average, currently around $58,000 to $60,000, has historically been a very strong support level and frankly a great long-term buying opportunity. Every time Bitcoin has touched the 200-week moving average in its history, it has eventually gone on to make new all-time highs. For long-term investors, accumulating in the $60,000 to $65,000 range could be a viable strategy, with the understanding that the price could still see further downside in the short term. The long-term bullish case remains intact as long as the price holds above the 200-week moving average. So, what are the potential scenarios from here? Let me lay out three possibilities. The bullish scenario is that the market has found a bottom. The extreme fear and massive liquidations have washed out the weak hands. We see a strong bounce from the $60,000 support, and the price reclaims the $72,000 and then the $84,000 resistance levels. This would require a shift in the macro environment, perhaps a more dovish tone from the Fed, a de-escalation of geopolitical tensions, or some positive regulatory news. The bearish scenario is that the bounce from 60,000 is just a dead cat bounce. The price gets rejected at the $72,000 resistance and then breaks below the $60,000 support. This would likely trigger another wave of selling and could see Bitcoin heading towards the $50,000 or even the $38,000 level, as some analysts have predicted. The sideways scenario is that the market enters a prolonged period of consolidation, trading in a range between 60,000 and 75,000 for the next few weeks or even months. This would be a period of uncertainty where both bulls and bears are fighting for control. Now, for the most important part of today's episode, how to actually trade this market successfully. For the short-term trader, focus on the lower time frames, the 1 hour and 4 hour charts. Look for quick scalps and day trades within the current range. Use tight stop losses and take profits quickly. Be nimble and ready to switch your bias from bullish to bearish as the price action unfolds. The key trigger for the next 24 hours is a break above 70,000 for a long, or a break below 68,000 for a short. For the mid-term trader, be patient and wait for a clear trend to emerge. Don't get chopped up in the sideways price action. Wait for a confirmed break above resistance or below support before entering a trade. Consider using options to define your risk. A put spread below 60,000 or a call spread above 75,000 could be effective strategies. For the long-term trader, this could be a great time to dollar cost average into your favorite projects. Don't try to time the exact bottom. Instead, accumulate slowly over time. Focus on projects with strong fundamentals that you believe in for the long run. Bitcoin and Ethereum remain the safest bets in the crypto space, but also look at projects that are building real utility and have strong developer communities. Let's expand on those strategies. For our short-term traders, it's not just about being nimble. It's about understanding the flow of the market on a micro level. Look at order book heat maps. Are there large buy or sell walls forming? This can give you a clue about where the price might be heading in the next few hours. Also, pay close attention to funding rates for perpetual swaps. High positive funding rates can indicate an over-leveraged long side, which could be a target for a short squeeze. Conversely, high negative funding rates can signal a potential long squeeze. It's a game of cat and mouse, and you need to be the cat. For our mid-term traders, let's talk about patience. It's easy to get FOMO when you see a green candle, or panic when you see a red one. But swing trading is about capturing the larger moves, the swings in the market. This means you need to have a clear plan and stick to it. Define your entry and exit points before you even enter a trade. Use a combination of technical indicators like the MACD, RSI, and Bollinger Bands to confirm your thesis. And most importantly, have a clear invalidation point. If the price moves against you and hits your stop loss, accept it and move on. Don't let a losing trade turn into a disaster. For our long-term investors, the key is conviction. You need to have a deep understanding of the projects you're investing in. What problem do they solve? Who is the team behind it? What is their tokenomics? Don't just buy a coin because it's pumping. Do your own research, and when you've found a project you believe in, have the courage to buy when there's blood in the streets. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. This is the time to be greedy, but selectively greedy. Focus on the blue chips of crypto, the projects that have stood the test of time and have a clear path to adoption. Before I wrap up, let me mention a few things that are not getting enough attention in the mainstream coverage. First, despite the price crash, Bitcoin's hash rate remains near all-time highs, which indicates that miners are still confident in the long-term value of the network. Second, institutional adoption continues quietly behind the scenes. Major banks and asset managers are still building their crypto infrastructure, even if they are not making headlines. Third, the upcoming US economic data releases this week, particularly the CPI on February 13th, could be a major catalyst in either direction. If inflation comes in hotter than expected, it could push the Fed towards a more hawkish stance, which would be negative for crypto. If it comes in cooler, it could reignite hopes of rate cuts and spark a rally. And there you have it, a deep dive into the current state of the crypto market. It's a challenging environment, but with the right knowledge and strategy, you can navigate it successfully. Remember, this is not financial advice. Always do your own research and trade responsibly. The market will always be here tomorrow, so there's no need to rush into anything. And thank you for joining me on Boni's Life. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next episode. And I want to hear from you. What are your thoughts on the market? Are you bullish, bearish, or somewhere in between? Let me know in the comments below. Until next time, stay safe, stay informed, and happy trading.